Good morning, viewers, and welcome to the channel. It's been a bit of a break from the last video, so welcome back. Anyway, this week's video and the first of the new year is on Magellan. Title here is "With Hamish Douglas taking a break from Magellan, is there even more pain to come?" I've got a few slides here. Obviously, this is chart of Magellan since December 2014, which is possibly when it listed. So I didn't put the chart together. Anyway, obviously, a pretty dramatic chart really in recent years. Kind of a slow grind up there, but this as it became as Hamish Douglas really became a well-known, almost household name in Australia and started to attract massive retail and institutional inflows. We saw share prices above $70, easily traded at the biggest multiple as far as fund managers are concerned on the ASX. And then we saw it fall, obviously, as March of 2020 hit us, which was the beginning of the pandemic, before recovering. And then, of course, some pretty big underperformance, at least at a fund level, has caused to this massive change. And this is really where things have started getting ugly, as its performance has continued. Well, its underlying performance has continued to be worsen. It's lost a significant institutional mandate, St James Place from the UK, which was, I think, about $20 billion. And we've now, of course, just seen Hamish Douglas step away from the company to focus on his health, which my guess would be mental health. And I think ultimately what we're seeing here is the pitfalls of the strategy of the company, which did an excellent job of marketing Hamish Douglas as Australia's version of Warren Buffett, and that really worked out well during this period of time. But what happens, of course, with fund managers is that every fund manager goes through periods of underperformance, and when you've effectively anointed yourself as the investment guru of Australia, that celebrity can wane very, very quickly. And and ultimately as well, it's because of, I think, the persona that he had built up and the company had built up for him. Some of these big bets that he had made, such as, for example, keeping a big 20%, I think, cash exposure in the portfolio, as from lows during the pandemic. Also, betting big on China despite huge government regulatory issues that emerged. I think because of that persona, sticking to those long-term bets rather than occasionally saying I was wrong, has been a huge issue, and has led to more underperformance. And even now, as US reporting season has started, the big bets it's made of late, such as a huge position in Facebook or Meta as it's now known, has come unstuck as although it was perceived, at least by Hamish, as a value stock. It fell 25% on its results. Some real issues for Facebook on a company-specific issues, not affecting the whole industry or not affecting all social media companies, but very much specific to Facebook. That it looks like Magellan missed, and is causing kind of a bigger loss of faith. And we're now starting to see client outflows as well from retail investors, not just the big institutional ones like St James Place. So I'm just got some charts here. Alibaba, big position of Magellan's for a while, and over the last 12 months, continued to underperform, almost down 60%. And Facebook, which was at least in line with some of the bigger name tech stocks which were holding up the Nasdaq, now even that's down 20% over the last 12 months. So, these have been big hits. Another chart here. This is their listed ETF, which is their high conviction trust. Again, since this is over the last year or so, or rather since listing, actually. So it's 31st of August last year. Pretty much in line. Actually, if anything, outperforming the ASX 200 at one point. And then as some of these big high conviction bets, and that's likely a big part of that is Facebook, have come unstuck. You can see the performance has been certainly well below the ASX 200 and a hell of a lot below the S&P 500. And where to now, I guess, the problem, I guess, for Magellan is it's all going to be about performance. They've built up this profile for Hamish Douglas, and him walking away is a big risk for the company, because they've been able to get more bang for their marketing dollars than other funds management companies because of his celebrity. Now bringing in Chris Mackay, who's far lower profile, to head it up. Even with a kind of a similarly excellent long-term investment track record, probably won't do enough as far as attracting new client inflows, at least in the short term. So I think that as an investor, what I would want to see is the performance starting to stabilize at an underlying level, such that at least client outflows are no longer a factor. This thing's trading on the cheapest multiple, for many years, because the expectation is that they're going to continue to see client outflows. And I think if they can stabilize performance, which you'd like to see with these new roles coming in, which is, as I said, Chris Mackay, but also Nikki Thomas, who's actually used to work here, so I know well. She's an amazing investor. If they make some big bets, change the strategy of their portfolios, and start to perform better, and the client outflows slow down and maybe start to turn around, then ultimately I think this can be a really good value play. But as we've seen with Platinum, in the late 2000s and early 2010s, underperformance can take a long time to turn around. And once that kind of celebrity has died down, it's very hard to turn around the public's perception of your company. So that's kind of at that really dangerous position Magellan's in right now. So I'd say if they don't turn around performance in the next 6 months or a year, it could be terminal. Not necessarily for its business, but rather for its for its ability to turn around and become the star fund manager that it once was. Anyway, that's it for this week's video. Thank you for tuning in. Good to be back, and I'll be back next week with a new video.